Hey, good afternoon, everyone. Okay, so let's just jump right in and take a look at what the markets did today and try to keep that in context of where they've been and what they may be trying to accomplish. So I've got March corn up in front of you. You know, the USDA report on Friday was really kind of a neutral. And anytime you have a neutral report, it's always viewed negatively by bulls because you just kind of have to have a, a bullish sentiment, or bulls have to be fed, as they say, especially in a carry market, because if there's not something radically bullish, then markets tend to get sold. So that's just kind of where we are from a market mindset standpoint. But what I think really is going on, I think you've got this 490 level right in here that provides all of this chart support. You can see all the opens and closes that are sitting right down here at this level. That's where all these candlestick real bodies get absorbed. And then we came right up to it, failed, and now we're pulling back away from it. If as long as these lows right here hold, and I really like this December 1st low, as long as that low at 478 and 3/4 holds, I think that's the level that we need to trade from. That's the low on December 1st, and a lot of times the first marks the highs or the lows. It's also the 68% retracement of this move here, and it is just a nice pullback here. It's the wave 4 of 1 degree lesser. So a lot of reasons that I think this needs to hold. As long as it holds, I think March corn can come and retest this. A lot of times you got to back the truck up, but you've got 5 waves up. Now you've got 3 waves back down right into the 61.8, and I think that if that can just find a little bit of support and buying, then up we go. Where would that buying come from? Well, you've got quite a bit of strength in beans, right? Beans really started to push higher. You've got a nice 3-wave corrective structure down off the peak in here. If beans can reclaim this elbow right up here at 1352, then they should really accelerate to the upside if this count here is looking correctly. So do they have the fundamentals to do it? Yeah, of course they do. Beans do. You can make bullish arguments in corn, although they're more difficult to make in corn than they are in beans, but you can still make them. And there's a lot of unknowns yet. So markets can rally for little to no reason. They don't necessarily have to be fed every day. And I'm not saying we go to new highs. I'm just saying that they can rally. So there's no reason that we can't put pressure on some of these levels up here. But continued weakness here, anything below this level here, or even today's low, is something that we're not very excited about. So yes, there's downside risk. Yes, there's something to be worried about here. But given what beans are doing, I think that up is more likely than not as of today. And obviously price action will have to either confirm that or deny it. Okay, Nove 24 beans, they look really good, climbing back up above their hedge line here and above their this uptrend line. We'd like to see this just explode up out of here and get higher and come attack these highs up here at 1350. 1320 again, and push on up to new highs so we can open this thing up to the upside. So we'll be patient. We're going to let the market do what it needs to do and see what the catalyst that propels it is, if it does in fact come to fruition. Wheat was really the market today that was in bad shape, unable to find any strength and rally. But I do want to point out one thing, and if I could put corn overlay on here, I would. You've got the same structure. We've got 5 up, and now we've got 3 back. This is exactly what we've been looking for. And like corn, it's pulled back to the 61.8 retracement. Sometimes you can get to the 78.6. So as long as 617 and 3/4 holds on March wheat, I think it's fine. Anything down into that setup is an acceptable risk in our opinion. So whether you want to own calls, sell cash, that's fine. If you want to just hold your cash, that's fine too. If you wanted to put a put on something down here, that's fine as well. I have no arguments. You know, we thought today we'd get a 9, which would have been a signal that that we needed to buy some out of the money puts on wheat. But the reality is that the market didn't post the 9, which I think ends up more bullish than not, because this retracement came at the perfect time to avoid it. It's coming right back to the levels that we want to see it come back to. Now we want to see it reverse from here and work itself back up higher. Who knows if that happens or not, but a lot of times the sentiment, if this is correct, is the most extreme on this full pullback. And the bearish sentiment will even eclipse what the sentiment was at the low. So you've got the rally, you've got a 3-wave pullback right into Fibonacci support, limited risk, unlimited upside. It's a nice setup. On the flip side, yeah, it was a big down day. That's a 3 inside down. So we do have a sell signal here, but more than anything, we just don't really have any confirmation of any other type of signal. So the 9 got taken away like we were looking for on Friday, and so today it's a patient day, it's a wait and see day, and we'll have to see what happens. So tomorrow will be the day. Tomorrow's close will tell us a lot. If we're going to close here or lower, we're going to probably need to sell it. If we're going to find any strength, we've got to do it up above the 618 level. So mind your texts, mind your calls, and we'll talk about what to do. July wheat was about the same. No difference in opinion here. If it does continue weaker, obviously we need to sell it. But on the other hand, this market is really starting to show some bullish signs. For instance, the call skew. If you take an option and you price that option out, that is 40 cents out of the money versus 40 cent out of the money put versus a 40 cent out of the money call. The call skew is usually between 5 and 10%. Usually you'll have a call worth 2 or 3 cents more than what the puts are. Today they're almost 40% more expensive on the call side than they are the downside, or than they are the puts. So puts are very, very inexpensive relative to calls. That tells you what the market makers are worried about. It tells you that they're putting premium on higher prices. They're commanding more premium to sell you call options because they're perceiving more upside risk than downside risk. That's why the options get skewed. If we looked at this last Thursday, Tuesday, Wednesday, Thursday, that call skew was much less. It was normal. We were about parity. You could go 40 cents out of the money and the options cost about the same. Today, they're much more expensive to the call side, which is actually a more bullish signal than bearish, giving a little bit of credence to the notion that this pullback should stick and hold. Can we go make new lows? Yep, 100%, absolutely we can. I'm not saying that we won't. I'm just saying from a risk-reward standpoint, this is where we are. So if we pop a little lower, what do we need to do? We need to sell it, hedge it, but get that upside reopened relatively quickly, because that call skew is in effect. So a day at a time. We'll just have to wait and see how it trades tomorrow. And I'd look to corn and beans for wheat's guidance as well. I just think it's extremely unlikely that wheat plummets and corn rallies and beans rally. So we'll just have to wait. We'll just have to see how traders decide to take that. But that's our view for today. Remember, there's risk trading futures and options, and you should only do so in light of your own financial condition. If you have questions, call us. We'd love to talk to you. If you have any concern about positions, please reach out to us, and we will walk you through it and make sure you're positioned comfortably and where you want to be. Hope you guys have a great night. We'll talk to you later. See ya.